Ladies and gentlemen, Edgy here. Look at your screen. Really look at it. Silver, $75. Red candles everywhere. Twitter is screaming crash. YouTube thumbnails are yelling bubble burst. And I know exactly what you're feeling right now. That tightness in your chest, that voice in your head asking, did I mess this up? Because just 2 days ago we were celebrating $79, all-time highs. People were talking triple digits. People were saying, this time is different. And now, Monday morning, no warning, straight down. So let me ask you something very, very simple. What actually changed? Did new silver supply magically appear over the weekend? Did China suddenly announce, never mind, export ban canceled? Did global industrial demand just disappear overnight? No, nothing changed. So if nothing fundamentally changed, why did the price collapse? Here is the answer that most people do not want to hear. This is not a silver move. This is a timing move. Welcome to Ghost Week, the dead zone of the financial markets. The week between Christmas and New Year's. This is when Wall Street is a ghost town. Senior traders are gone. Risk managers are on vacation. Now, we need to talk about why this move had to happen. Not emotionally, not conspiratorially, structurally. Here's the uncomfortable truth most silver bulls do not like hearing. Markets do not break to new highs without first shaking people out. They cannot. If silver had gone straight from $79 to $90, with everyone confident, with everyone fully loaded, with no fear in the system, the leverage would be off the charts. The system would have snapped instantly. So instead, the system does what it always does. It tests conviction. It tests who is strong and who is weak. This drop to $75 was not random, and it was not bearish. It was required. Let me explain it in simple terms. Right now, silver is one of the most crowded smart money trades on the planet. Hedge funds, macro funds, industrial buyers, even governments. They are all positioned. But retail? Retail just piled in late. They chased the breakout. They bought expensive call options. They went on margin. They put tight stop losses everywhere. And that creates a massive problem because leveraged optimism is incredibly fragile. So before the next leg higher can begin, the market has to do one critical thing. Flush the leverage. This drop was not about price. And the answer right now, at this very moment, is no. Supply did not improve. Physical inventories in vaults did not magically refill. China did not reverse its strategic policy. Industrial demand for solar panels, for electronics, for electric vehicles, it did not pause. All that changed was the number on your screen. And during Ghost Week, that number lies. Thin volume exaggerates everything. A normal, healthy 5% pullback looks like a total collapse. A simple liquidity air pocket looks like a market crash. But it is not a crash. It is a vacuum. And in nature, vacuums do not stay empty. They snap back hard. Now, here is the key insight from all of this. The market did not drop because the sellers are confident. It dropped because the buyers stepped aside. And there is a monumental difference between those two things. Real informed sellers sell into strength. They sell when everyone is buying. Fake, engineered drops happen when the natural buyers simply vanish. And when do buyers vanish? During the holidays? During Ghost Week. That is why timing matters more than the narrative right now. We are 3 days away from January. 3 days away from full trading desks. 3 days away from real, substantial volume. 3 days away from the market pricing physical reality first, and paper promises second. So I want you to ask yourself one single question. Would truly smart money, with all the data, dump their silver position 3 days before a proven, scheduled supply shock? Or would they try to scare you? The retail holder, out of your seat first? The answer is obvious. Exactly. Stay with me. Up to this point, you might still be thinking, okay, silver is tight. The paper market is stressed. The physical market is strong. I get it. But why did this have to explode right now? Why this week? The answer, once again, is timing. And timing in the financial markets is everything. Right now, we are inside the single most dangerous window of the entire financial calendar. Wall Street has a name for it, Ghost Week. The period between Christmas and New Year's. This is when the senior traders disappear. Risk managers go offline. Liquidity providers pull back their capital. Big bank desks flatten their exposure. What is left behind? Junior traders, skeleton crews, and automated algorithms. Here is the critical mistake most people make. They think low volume means low risk. It is the exact opposite. Low volume removes all the shock absorbers. In a liquid market, large orders get digested slowly. In an illiquid market, even a relatively small order can cause a violent, exaggerated move. That is why silver did not grind lower over several days. It dropped straight down. No negotiation, no resistance, just air. That $75 print was not true price discovery. It was a vacuum. Think about it like this. In normal conditions, dumping 1,000 silver contracts is like throwing a rock into the ocean, a small splash. During Ghost Week, it is like throwing the exact same rock into a bathtub. Same action, totally different impact. That is why the chart looks absolutely terrifying. And that is intentional, because Ghost Week is not about fundamentals. It is about psychology. The big banks, the liquidity providers, they know exactly where retail pain lives. They know who bought at $78. They know who is on margin. They know where the automated stop losses are sitting. And in thin ghost town liquidity, they can push the price down to those levels very, very cheaply. So they push, not because silver is fundamentally weak, but because you are emotionally vulnerable. This is how traps are built in modern markets. Flush the weak hands, trigger the stop losses, force the panic selling, and then quietly, methodically, buy back what they just scared you into selling. That is why this move happened 3 days before January. 3 days before the new export rules change. 3 days before the trading desks return in full force. 3 days before fresh institutional capital enters the new year. Smart money does not sell before a structural event. They position for it. And here's the detail that matters most. While the paper markets were collapsing, the physical markets were closing. Bullion dealers stopped quoting firm prices. Inventory disappeared from online platforms. Call for pricing replaced the buy buttons. That is not demand collapsing. That is risk refusing to sell. If you are a physical dealer, and you can sell silver at $75 today. But you know the Shanghai Exchange is paying the equivalent of $85. And you know export controls begin in just a few days. Why on earth would you sell? You would not. You would freeze your inventory. You would hold. You would wait. That is how real shortages actually begin. Not with dramatic panic buying, but with sellers quietly stepping aside. Now, look at January. Fresh capital allocations. Institutional portfolio rebalancing. Fund managers chasing last year's best performance. Silver was one of the strongest, best performing assets of the entire year. That attracts attention. That attracts capital. And we must remember, the silver market is tiny. It is a small, niche market in the grand scheme of global finance. It does not take much new money to completely overwhelm it. So when the desks reopen on January 2nd, they will not be buying into a calm, orderly market. They will be buying into a fractured market. A market with missing inventory. A market with pent-up physical demand. That is how gaps form on the chart. That is how limit-up days happen. Ghost Week did not create the underlying problem. It exposed it. And once that exposure happens, there is no rewind button. Now we get to the part everyone actually cares about. What happens next? Not hype, not predictions pulled from thin air. Just structure. Because markets, in the end, do not move on opinions. They move on constraints. Here is the reality. Nothing that caused this initial move has been resolved. Physical supply did not increase. Chinese export controls did not disappear. Global industrial demand did not slow down. Exchange vault inventories did not refill. The only thing that changed was the price on a screen. During the weakest liquidity window of the entire year. That is why this move feels so confusing. Because psychologically, it looks like failure. But structurally, it was a stress test. And stress tests are designed to shake confidence, not to reflect reality. This is why experienced commodity traders do not waste time asking, did the price go down? They ask one question only. Did availability improve? Can I go and get the physical metal more easily today than I could last week? And the answer right now is a resounding no. Availability is getting worse. Shanghai did not collapse. It stayed bid. Physical dealers did not dump inventory. They pulled it. Industry did not pause their demand. They accelerated it, trying to secure Q1 supply. That tells you everything you need to know. So what happens when January arrives? 3 things happen at the exact same time. First, the rules change. China's new export licensing framework goes live. The flow of silver out of the country becomes selective, not automatic. Second, liquidity returns. Senior traders sit back down. Risk desks wake up. Institutions look at their screens and see the damage that happened while they were gone on vacation. Third, capital resets. New money enters the markets. Performance chasers wake up. Silver shows up on every screen as one of the strongest assets of the previous year. That combination is explosive. This is why the moves after Ghost Week are rarely smooth. They are rarely slow. They do not crawl. They gap. Because the market tries to correct weeks of distortion and illiquidity in a matter of hours. That does not mean silver moves in a straight line up from here. There will be volatility. There will be sharp spikes and equally fast pullbacks. There will be moments of fake calm. That is not weakness. That is transition. That is the sound of a market, changing its pricing mechanism from paper promises to physical scarcity. Here is the mistake most people make at this precise stage. They try to trade every single move. They try to sell at 85, buy back at 80, sell again at 88. That strategy works in stable, liquid, paper-driven systems. This is no longer a stable system. When paper control weakens, algorithmic volatility dominates. Stop losses will get hunted in both directions. If you try to be too clever, if you try to outswing the swings, you will get chopped up. You will lose. That is why the professionals do not play games here. They position, they establish their core holding, and then they wait. Because once an asset moves decisively from financial pricing to physical scarcity pricing, the rules of the game change permanently. This does not mean silver becomes a straight line up. It means the floor rises. It means the baseline from which we measure price is now higher. And the ceiling, the upside, becomes fundamentally unpredictable. This is why $75 was not a failure. It was the final test. A test of conviction. A test of understanding. A test of whether you were watching the price or whether you were understanding the structure. The trap was not built for everyone. It was built specifically for those who did not understand what they actually owned. Because the market does not reward blind belief. It rewards preparation. It rewards insight. It rewards the ability to see the game within the game. Silver is not special because it is shiny. Silver is special because it cannot lie. It must be delivered. It must be refined. It must be consumed in a factory. It is a tangible reality in a world of digital promises. And when that physical reality finally collides with decades of paper promises, something has to break, something has to give. This time, it was not the metal that broke. It was the illusion of control. This was never about silver going up or silver going down. This was about the system revealing its true nature. It was about the curtain being pulled back for just 1 week. Ghost Week. So you could see how the machinery really works. They are rare. They are consequential. And the people who understand them early, who see the setup while everyone else is staring at the confusion, those people are never the ones chasing the move later. They are already there. They are already positioned. This is the moment. This is the transition. Do not let Ghost Week steal your conviction right before the real move begins. The vacuum is about to snap back. Be ready. Subscribed.